Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, there is a lot to keep pulse of between trade headlines and really everything else.
Well, yeah, after we already took care of the jobs report and Mag 7 earnings.
Yeah, that's a big one, actually, to have those out of the way. Let's get to the biggest stories right now in the more than $17 trillion global ETF industry. And we start with stocks rebounding after the sell-off on Friday, fueled by weak jobs data amid bets that the Fed will soon cut rates.
And in just a few minutes, we'll speak with Travis Spence. He is global head of ETFs at JPMorgan Asset Management on the record flows in active funds.
Plus, Ether ETFs in the spotlight. We'll discuss why the funds are having a huge boost emerging from Bitcoin shadow. All that and more coming up. But as always, Eric Balchunas is with us now from Bloomberg Intelligence, and he's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. So last week we had a dip, and guess what? The ETF investors bought the dip. No shocker. IVV, $6 billion. That's a ton. Probably a model rotation. That's a lot of money. VU, it's always at the top. Dip or not, you're going to see VU up there. VTI and the Qs. Qs is trading money, so that's a lot of trading money right there. That's a pretty clean sweep of U.S. equity buying in the face of the sell-off last week. And the market up today is not a surprise. More on that in a minute. A little bit of S-Gov here, though. That is treasuries. So, you know, we could say maybe some people are protecting themselves. Misty's interesting. This is the Yield Max MicroStrategy that yields 144%. Rates call options just out of the money on MicroStrategy to get a jacked up yield. People love this, $6 billion. Where to see that on this leaderboard? Let's look at the outflows. And you're going to see at the top, again, pour another one out for small caps. They just can never get going. I feel bad for them at this point. If you look at any period, 1 month, 1 week, year to date, 5 years, they're always lagging. And I can tell some traders will pile in and try to make it work, and it doesn't, and they just come right out. We'll see if anything can help them over the years. SPY outflows, RSP, this is equal weighted SPY, a little bit out of TLT, some leverage Qs. So not totally bullish, but again, net bullish. And $100 billion, by the way, went into ETFs in July. So that's a lot of money. Now, this dip buying situation here, this is a chart of looking at past dips 3 months before and 3 months after. So you can see here in April, they bought the dip, and that was a hard dip to buy, I got to say. It looked pretty scary in April. This was the money before the tariff tantrum, and this is the money after. So almost the same amount of money went in. And you can see in October of 2022, more money went in after the dip. Why? It works. Athanasios Sarafagos on my team looked, and generally speaking, the dip buying works at different degrees over decades, Katie. So that's why people are buying the dip.
Eric, thank you. Joining our conversation now is Travis Spence. He is global head of ETFs over at JPMorgan Asset Management, joining us on set. Great to see you in person, Travis.
Great to be back. Thank you, Katie.
So let's pick up where Eric left off, and that is this dip buying impulse that just doesn't seem to be able to be drained from this market. That seems to be mostly the retail set, the Vanguard set that Eric often talks about. What does it look like from the seat of professional money managers? Are the portfolio managers over at JPMorgan Asset Management also looking to add here as we see stocks sell off?
Well, look, we've got 8,500 people that are really focused on just one thing, and that's active management and finding ways to outperform every index that we compete against. So I think now, we expect that this tariff tantrum, which again came out on Friday, that works itself out through the second half of the year. And so we are finding opportunities, and there are opportunities that are coming out of this. This is where, it's another reminder that active management is really relevant in a year like 2025, when you've got, both the Fed in play, but you also have the tariff and the impacts from that are working themselves through the system.
So when you see the dip buying taking place and at least the interest in active funds, can you give us a sense of what that looks like on the fixed income side versus on the equity side?
Yeah, well, let's take a step back. Active, continues to be, and I think last time when I was here about a quarter ago, we said we think 2025 is the year for active ETFs. And so you continue to see that come through. Flows, about 40% of total flows, but we're on record pace. So there's $250 billion here in the US that have gone into active ETFs. That's relative to about $300 billion as a record last year. So we're going to exceed that this year by far. Globally, that number is about 350 last year was the record, and we've already hit 300 billion. So it's not just happening in the US, it's happening across the world. But that's one thing. The issuance is the second part that we look at. So 85% of all new ETFs issued in the US this year have been active. That's been interesting because we've seen a lot more activity around the derivative space. In a year like this, downside protection becomes more important, as does fixed income. So if you look at the fixed income flows, also record pace of fixed income flows in the ETF market, but active is taking in about 40% of all the fixed income ETF flows. We think that's a huge space for growth. I'll talk a little bit about that, but I think we're gonna continue to see more and more flows on the active fixed income side.
Looking at the market, I mean, like the equity premium ETFs use call options and they do buffer your downside. And I'm wondering, with this buying of the dip, and if you look at the market through like a CFA lens, I mean, you're probably going to get burned over and over. How much does it matter to have these sort of things in the ETF, like buffer ETFs or equity premium? We're using options almost to help protect the investor versus relying on the human to like navigate this course, because this is not easy.
Look, we're seeing both, but I think if you look year to date and just within the active ETF space, the biggest category is still derivative income. So even though we saw that dip in April, you saw the buying of the dip, across the market, there are still a lot of investors that are nervous and they want to get, they want to get into the market. And I think the derivative income space and other buffered spaces are an ability to stay invested, get invested and stay invested, which is so important, as we all know, in these parts of the market. But that derivative income space has proven to be a way for investors to feel a little bit comfortable about getting into the market. So I think that's part of why we've seen that be the top category year to date. Ultra short bonds, and we have JEPI, as you mentioned, we have JPST that sits as the largest active fixed income ETF. Both of those have seen record flows this year. But in addition to that, Eric, you're also seeing active just become a bigger and bigger part. So if you take a look at all the strategies that we have outside of JEPI, JEPQ, and JPST, actually about 50% of our flows are coming in a wider range of active ETFs. So that's investors looking for more active management in the ETF vehicle in times of continued turbulence.
Well, we're talking about active ETFs broadly, and included in that category are leveraged single stock ETFs. We have a great chart comparing monthly volume of single stock ETFs versus what Bloomberg Intelligence calls traditional stock picking active ETFs. So you take a look at that, you can see the single stocks in blue just blows traditional stock picking active ETFs out of the water. Do you look at that chart and say, man, JPMorgan has to launch some of these single stock funds?
There's always, the innovation is great within the ETF wrapper. We all know that in this industry. And there's always going to be a place for these kind of innovations. Not something we look at, like we're going to be very considerate about the things that we do within active management and where we want to really weigh in. For us, that's around leveraging our fundamental active capability. Research is at the heart of what we do. We invest almost 500 million every single year in research. We have over 375 research analysts, one of the largest on the street. That guides everything we do. So we're not going to be in this space of single stock leverage. We're going to make sure that we put active into the core building blocks that you want to have in your portfolio. And I would just say, making up that core part of the portfolio, that's where you look for JPMorgan Asset Management.
That totally makes sense given the synergies you want to create with the other parts of your business. But do you worry that perhaps you're leaving money on the table by not meeting that demand?
It's okay. There are managers who will do that. It won't be us. But we're happy to, we'll continue to focus on the strengths of what we do best.
Yeah, I mean, your numbers are ridiculous, right? So JPMorgan has taken in 4 times more than any other active fund shop in the past year, which I think shocks people. You're now the 4th biggest active manager in America. You just passed DFA, PIMCO, so they're on a roll. When I do look at why you're successful, one of my theories is if you are competing in the core, you do have to compete on fees because you got Vanguard and BlackRock in there. But you guys are pretty good. You have the ETFs priced at your R6 mutual fund class. How important is the guts to get a little bit cheaper for active managers these days?
Look, I think it's about coming up with a price point that for a strategy, given the amount of volatility we're taking in a strategy, that makes sense, right? And then within the ETF industry, the advisors can then weigh into what they create as value on top of those ETFs. So we want to create those building blocks at reasonable price points that make sense for the investor. I think that has been a very successful strategy, to your point, Eric. But that's what we're really focused on when we think about that product development process.
All right, Travis, always great to speak with you. Appreciate you taking the time. That is Travis Spence of JPMorgan Asset Management. Now, coming up, a big boost for Ether. Why the ETFs surrounding the cryptocurrency have recently been on a tear. That conversation up next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with ARK, the ARK Innovation ETF. We haven't looked at this in a couple months now, it feels like, but really investors taking another look at ARK right now. You can see that last week it took in its biggest one-day inflow ever, more than $800 million in a single day, surpassing its previous record set all the way back in 2021. So ARK in the spotlight right now. Let's talk though about India. I thought this was interesting. We're looking at the intraday chart of the iShares MSCI India Index ETF. And the reason why is because we heard from President Donald Trump earlier today saying that he's going to substantially hike the tariff on Indian exports to the U.S. He didn't say by how much, but he did say last week that he would put a 25% rate on Indian exports. So you can see the intraday reaction to that Indian equity ETF right there. But let's end with Ether. We talk about Bitcoin a lot on this show, but right now we're talking about Ether because take a look at those monthly inflows. This is Ether. That is the iShares Ether ETF, and you can see that is a big green bar for the month of July.
Yeah, July was kind of the turning point for Ether as an asset overall. So let's talk about this with Bloomberg's Isabelle Lee. Isabelle, what's driving the inflows into Ether ETFs?
I think it's a feedback loop because price attracts flows and flows drive price. And really a lot of things are going on. It's almost like the perfect moment for Ether because there's momentum, regulatory clarity, and just institutions really piling in to the asset. I remember when Ether ETFs launched in July, and all of us in the team, Katie and me, we were just like, no one is piling into it. And then if you look at the year to date, as a cohort, especially for Ether, it attracted $6 billion, but $4 billion alone was in July. If you look at from February to June, you even see outflows. So it really is just recent.
I had a family member ask me about Solana this weekend, and I was like, I don't know, man, what to tell you. It feels like, okay, Bitcoin, we know that story. Ether, it seems like Wall Street is warming up to this story, but this flow, this demand, this interest that we're seeing, do you think that it's going to expand to some of the other coins? Do I need to be able to explain what Solana is?
You definitely need to explain what Solana is, but Ether is the biggest, second biggest coin, biggest altcoin. So I feel like it's the backbone for tokenized assets, for stable coins, which we saw regulatory clarity on. And for the longest time, it seemed just like an imaginary concept, a thesis. But now I think Wall Street is preparing to see it in actuality, in real life. And Solana is a competitor of Ether. Many people say it's cheaper and sometimes better, depends on who you ask. But for now, I think it's really Ether's time to shine. And it's really exciting. You see the likes of Tom Lee piling into it and making their own Ethereum treasuries.
Well, on that note as well, you also have the staking component for Ether, which differentiates it from Bitcoin, right?
That's exactly what they like because you generate income, you don't just hold it. I mean, for the longest time, that's really the elevator pitch of Ether. It's more than this, just digital gold. It's more than just an asset. It's something that can generate income. It's like the internet of digital assets. You can build stuff on top of it. And the treasury company, that's their biggest selling pitch, that they have really yield. And Bernstein actually came up with a stat saying that in July alone, Ether treasury companies acquired 1% of total circulation of all the Ether.
Want to hear a mind-blowing stat?
Yes.
Please.
Pretend the Bitcoin ETFs never launched.
Okay.
ETHA would be the fastest ETF ever to hit $10 billion.
That is crazy.
Isn't that crazy?
That is crazy.
It beat IBIT.
This is like relativity. It'd be like playing with Michael Jordan in the 90s. You could be the greatest player, but because
lost
he's in the
me
league,
again.
Yeah, you don't
sorry.
matter.
Okay. Anyway, Ether at 10 billion in only a year is the fastest growing. The problem is the Bitcoin ETFs are faster, but still Ether 13% of the market share. Do you think it'll get into 20, 30%, or do you think it's kind of like hitting a roof?
I mean, possibly. No one thought that they were going to attract something like this. And under this pro-crypto administration, anything is possible. And I saw your tweet. ETHA was the third in terms of largest inflow ETF. Second is IBIT, and first, of course, is VU. But can you imagine? It's now ranking third. So maybe it'll be first in August. Who knows?
Who would have thought, given the performance in the first half of the year, right?
Not me.
All right. Well, Bloomberg's Isabelle Lee, thank you so much for the latest on ETHA and all the momentum that it's gathering. Still ahead, we drill down into humanoids and the Magnificent Seven with Dave Mazza of Roundhill Investments. That's next. And just a reminder, you can listen to Eric and Joel Weber on Trillions, their podcast that covers the industry. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And it's time for today's drill down where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at Human, H-U-M-N, the Roundhill Humanoid Robotics ETF. You know what a humanoid is. It's basically a robot that looks like a human. You start to see them coming out. They're building them, and there's a wave of this trend coming. And ETFs like to capture these trends before they fully break, and that's what we're doing here. Expense ratio 75 basis points, just came out a month ago, 6 million. Again, very small. Let's look at what it holds. So you will recognize the first two names in here, Tesla and NVIDIA. These are two big leaders in the theme space, but this is an interesting dynamic. If you look, I'm going to go over here for a second. Tesla is 11% and NVIDIA is 9%, so 20% in those two stocks. So you're going to get stocks you might already own, which is, again, this is the tension between how you build a theme ETF. Let's look at this one compared to the other humanoid ETF. There's only two. COID, which is from Crane Shares. The assets are both small, expense ratio the same, but look at this one. Top 10 holdings as a percent of the portfolio. So Human is very top heavy. Those big names make up the large part of the portfolio. This one's more spread out. It's more like an equal weighted version. And this is a big factor. What do you want? Tesla at the top here. And here's a company you probably don't know, MP Materials. And then you can see here, this one has more US, a little yes. So a little smaller cap, more international over here, more US, large cap. They're going to have different outperformance streams, but you have to decide as an investor how much you want those large names in there. Katie.
Eric, thank you. Joining us to talk about this ETF, I'm pleased to say we have Dave Mazza. He is the CEO of Roundhill Investments. Dave, great to have you with us. What's interesting to me is that both COID and, of course, the Roundhill Humanoid Robotics ETF, you both launched just this past June. So this is a very, very young category. And I'm wondering what you saw out there that made you decide now is the time to launch this thematic ETF.
Yeah, you're absolutely correct. Humanoid robotics is a bit of a nascent theme, but behind the scenes with all the focus on generative AI has been the ability actually to really commercialize and develop humanoid robots. And why is there so much kind of attention being spent on it today? It's because they're really intended to help fill massive labor gaps that we had. There's 600,000 jobs in manufacturing, according to the most recent JOLTS data, that are unfulfilled because they're focusing on three areas. Dull work, so super repetitive tasks. Imagine stocking the shelves for hours and hours. Dangerous work, going in and dealing with hazardous materials, or dirty work, cleaning out sludge tanks, and things of that nature. So humanoid robots can actually help fill a labor gap that we need, even with still relatively low unemployment.
I'm looking at the holdings here in the fund, and Tesla is the biggest holding at 11.5%, even though Optimus is not a fully proven concept and is not generating money for Tesla just yet. Walk us through why that is the biggest holding by such a large proportion.
Yeah, so I think the way humanoid robotics ETF from Roundhill's perspective is set up, it's not that dissimilar to how we run our generative AI ETF chat. The intention is to provide precise exposure to a theme. So investors have a lot of ability to access, mega cap companies and other names that are associated with it. But if someone's investing in humanoid robots, whether same as with generative AI, we believe the ability to be precise is important. So you're going to have Tesla and Optimus play a large weight, NVIDIA. But then if you look outside of those names, when Eric was up on the board there's many names that folks may not be familiar with. UB Tech, for example, and others in China or Korea that actually have robots in market today. So while those two names play a pretty outsized role in the portfolio, we actually think it's relatively diverse from companies that are actually commercializing human robots today or will be having the ability to do so in short order.
All right, Dave, when I think of a frontier tech ETF like humanoids, I got to be honest, I sometimes don't like to recognize any of the names because I want M&A pop. You know, in an area like this, you want smaller names to get a decent weighting, so when they get bought, you feel that 80%, 90% pop. Do you risk some of that by overweighting the Tesla and NVIDIA here?
I think you can certainly see that in other areas. But again, the idea is to provide exposure to companies that have direct plans to commercialize robots. The Optimus is already sort of being prototyped on factory floors. It's not just videos of it serving popcorn to customers most recently. You know, I think about a company that we have a decent sized weight in the portfolio, Hyundai Motors. And actually, you know, I think we think of Hyundai for their cars, but they actually own Boston Dynamics, which makes the Atlas robot. And Atlas for years has done, you know, incredible videos of acrobatics and massive mobility. But one of the reasons why they bought that company in 2021 is they view that as actually having the ability of sort of where is transportation going, the nexus of humanoid robots, self-driving, what have you. And even from Tesla's point of view, actually the sensors that are used and the technology that's used to train the Optimus robot is the same as what they have in FSD. So there's actually quite a bit of overlap that's occurring. And that's one of the reasons why, you know, Morgan Stanley put out a forecast, but by 2050, humanoid robots can be a $5 trillion market.
Yeah, truly a scary thought. I don't know. I think about robots and I get a little bit of existential dread. But anyway, Dave, we have about a minute left, and I want to talk a little bit more about overlap because, of course, you have the Humanoid ETF. You also have the Roundhill Generative AI and Technology ETF. The ticker there is CHAT. In both ETFs, NVIDIA is a top weighting, a top 2 weighting. And as these sort of nascent categories get developed, is overlap just a fact of life?
Yeah, I think it really is. I mean, you can think back about include our Magnificent 7 ETF in that category as well. The idea is to provide precise exposure. So whether it's humanoid robots, whether it's generative AI, or even the sort of Magnificent 7, and really the idea with NVIDIA for years now, especially since the Magnificent 7 term was coined in late 2023, there's been calls for them saying they're no longer magnificent. I think quarter in, quarter out, NVIDIA and others have shown that they are actually, in fact, very magnificent. You know, just look at this most recent earnings season. Mm-hmm. They're putting up growth of 26%. The rest of the market, 4%.
That's true. I actually read that in a Goldman note this morning. Dave, always great to see you. That is Dave Mazza of Roundhill. And you can read all about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. But that does it for Bloomberg ETF IQ, the television show. I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas. This is Bloomberg.